Hi, everyone. Welcome to our second webcast of 2026. So here we want to discuss very quickly the geopolitical situation that is unfolding, including the recent meeting between President Trump and President Xi, but also the opportunity set and the consequences for credit markets. In other words, who are the winners and who are the losers? And this is the question that has essentially concentrated in our mind over the past few weeks. We've been busy trading, but we've been thinking a lot about the long-term shifts and how the new environment will shape for the economy and for markets. I want to summarize our conclusions in a couple of slides. From now on, we are managing capital in a different age. And if I have to say two words, it's a reverse-Gorbachev. It's a return to the Cold War. It's a deglobalized environment. There is essentially a geopolitical point of no return that we have seen unfolding. And so in this new environment, what changes? National security is more important than economics. So national security has different priorities, and this is about resources, it's about grabbing strategic choke points, and it's about winning in technology and in defense. The conflict between the East and the West has become more hot. It's still a commercial conflict, but it does affect not just in the Strait of Hormuz, it does affect all sorts of aspects of economic policy. We'll soon have a new Fed chair. Kevin Warsh is going to take the Fed chair at the FOMC. And Kevin Warsh has a lot of ideas, but ultimately we know that the Treasury will gradually subordinate independence of the Fed. The Treasury will gradually become a bit more senior. This type of economic policy essentially does not aim at maximizing growth, but it aims at maximizing dominance and security in an environment where Western countries for the past 20, 30 years have been lagging on productivity and have been seeing China grabbing a bigger and bigger share of industrial production, up to 1/3 of global production. So the Western policy has changed. National security is more important than markets. Markets become an instrument. The Treasury is more important than the Federal Reserve, and the Treasury will influence monetary policy. We've been above inflation target for over 5 years, and core CPI printed at 2.8% this week in the US. There's higher government intervention, and it means higher spending, persistent spending, and it means persistent inflation. And there is a focus on strategic needs, not just on market demand. So markets will be controlled more and more often. So in this context, there are 4 strategic goods that governments are chasing. And we have been discussing this for a long time in our past webcasts and investor letters. We've been focusing on buying real assets, not just making returns on paper assets, on bonds or credit, not just making a return in dollars, which ultimately is a paper asset. And these real assets are energy, chips, metals, and defense technology. This year, markets have been very focused on energy and semiconductors. And government investment has been focusing on these 2 aspects, these 2 parts. But I think the other 2 also remain relevant for a number of reasons. Defense is changing. Metals and precious metals will remain important as governments continue to issue bonds and print. And energy and chips are obviously the last 2 pieces in the race to have a dominant technology. So let's talk about what this means for markets, for the economy, and for the opportunity set. If everyone is chasing these 4 assets, then what happens? At the expense of other assets? Well, we need to think about the opportunity set. We need to think about portfolio construction in a way where geopolitical instability is structural. We have the Eastern Bloc, we have the Western Bloc, and Europe is in the middle. Europe is very often seen as a vulnerable party with less coordination, but Europe also has some advantages. And one of the advantages is that Europe is always seen as the underdog in this race. Warfare has been rewritten, warfare is changing, and we are entering a multipolar world. Some of these things we've discussed in the past. But what this means for markets and for the economy is we have a very, very increasingly K-shaped economy with winners and losers in a widening gap between each other. And we have still very ample liquidity in markets. Even with inflation close to 3%, the Federal Reserve continues to talk about cuts, even after 5 years of inflation above target. Where is inflation in the UK? In the coming days, on 20th of May, we'll have core CPI for April, right? And the median expectation is 3.1%. That's for core, not for retail, not for RPI or the headline CPI. We've been above target for a very long time, and until recently, even the Bank of England was talking about cuts. So liquidity is still there. And the Iran sell-off of March was actually one of the shortest lived sell-offs in history, the fastest market recovery ever. Why? Because investors don't have a chance to buy risk assets at a cheap level, because policymakers don't want to have risk premia go up. And because in a conflict between East and the West cannot afford markets to sell off for a prolonged period of time. Therefore, liquidity continues to be injected in markets, even if inflation is well above target and might go above 3% in the coming quarters. So the result is the shortest sell-off in history. But while markets have gone back up, there is still dispersion. There are still winners and losers, and we want to understand what are the long-term consequences of this environment. Probably the Strait of Hormuz disruption will continue. So the energy prices will not go back to $40. There will be some persistent energy disruption, and there will be a race from Western countries to continue to develop their own energy. Venezuela, for example, is one of the beneficiaries. And President Trump tweeted a picture representing it as the 51st state just yesterday. Ukraine is a beneficiary. Ukraine holds 10% of titanium, of lithium, and 15% of corn and wheat globally. So there are some winners. There are areas where investment will go. But probably energy will come down, energy prices will come down somewhat, but will not come down to the pre-Iran levels. So inflation will be persistent, government spending will be persistent, fiat currencies might continue to devalue. And we think that having another energy surprise, another energy shock is probably not our base case. We think that there is actually a likelihood of a broader agreement between the US and China. But even with a broader agreement, energy prices will not come back to the levels where they were before. So our base case is for an agreement between US and China for where we are already starting to see the contours. And this agreement might entail that there is a closing of China and Taiwan, a peaceful convergence, let's say, between China and Taiwan over the coming years, with the US not aggressively fighting it. It might entail some level of cooperation in the Strait, where the US can achieve a strategic victory. And we have seen the incentives to achieve this deal. China needs energy and has essentially told Iran to back down. The US has been acting a little bit more independently versus the Israeli objectives. And so the two parties that were more aggressive, so Israel and Iran, have been calmed down. The US wants energy, China wants energy. The US wants also some access to the Strait, and China needs time to continue to develop. So the incentives are there for a temporary agreement. But despite that, we think that we will continue to have an environment of geopolitical conflict. Who pays for all this? Who pays for this conflict, for the race that investors, that governments are doing to achieve first place in AI, first place in defense, and to, in the case of the US, to re-onshore production? Well, who pays is simply bondholders. We have less trade, we have higher interest costs. So who has bought government bonds in these countries will pay the price of low real rates of high inflation. And yield curves have widened, but they continue to be well below where they should be versus inflation forecasts. Let's just think about the Bank of England inflation forecast for 2027, which is actually getting close to 4%. So imagine how yields currently compensate you for an inflation rate that could be at 3.5 or 4. So this is the world where we're going. And obviously some central bankers are trying to diversify by buying gold and buying other assets. But this is just a temporary relief. Eventually, there is only so many reserve assets that you can buy. And the only way to defend ourselves from this environment, in our view, is to buy real assets and to make returns in real assets that are not already crowded. But let's, for one moment, before we talk about the longs, let's think about who pays and who the shorts are. Government debt globally is 100 trillion. Governments continue to issue. You want to be long things that governments cannot print. You want to be long things that are scarce, that governments support, that governments want to buy, but you don't want to be long things that government print. So you don't want to be long government debt, especially in the long end, because you know that central banks will keep cutting and inflation stays sticky. We have been short duration. We monetized some of it in March. We reset our short duration positions in the last few weeks. But on top of the government debt, there is credit. Obviously, if rates widen a lot, then companies will have problems refinancing. Investment grade credit is at a 30-year tight. High yield credit is also very tight as a whole. Within that, there is dispersion. And then on top of that, in the risk spectrum, you have private credit, which is the last frontier of credit markets with 3 trillion outstanding, 40% of notional invested in tech, especially in the US, and 40% of negative free cash flow companies. Now, remember that this has been the AI capex that we have seen in the past few years has been the second largest capex in history in the US after the annexation of Louisiana, and has been funded not just with government debt, but also with private debt and with private credit. So we continue to be in an environment where governments issue more debt, and the private sector has found ways to issue credit, to issue debt in new vehicles, in new formats, to fund capex that is necessary in part, that is requested by companies that are involved in the technological race, mostly right now. 40% of private credit is tech. And some of it is going into distress, especially in the software space, as we know. Is it systemic? We think it could be, but the narrative now has shifted to the upside. So who are the winners and who are the losers? Credit spreads are extremely tight. We're at a 30-year low across markets, IG, high yield, emerging markets. And the widening that we saw in March, which was not very pronounced, has essentially retraced if we consider the market as a whole, overall. Having said that, there is a lot of dispersion within the market. So while some assets are very expensive, particularly investment grade, high quality assets, particularly US assets, the things that are essentially very high quality are extremely expensive. They don't pay you. It's a return-free risk trade when you're buying credit at 40 basis points. Having said that, there are assets which are a little bit less expensive, and these are assets where there is a story, where there is more stress, and lower quality assets, companies that might be more challenged, companies which might be a survivor or not a survivor. So that's where there is some interesting opportunity. But in this environment with a lot of change, we have to remember that bond investors are investing on the downside, so are investing on betting, that analyzing and betting that companies will not go down. But they're not capturing the winners. Normally, a bond investor is just capturing a coupon and maybe some upside on the bond. So if you're lending at 100 companies, you make 3, 4, 5% on each company, but you just need 3, 4, or 5 to go down to break even, to start losing money. In an equity portfolio, yes, you can lose a lot more on the losers, but you'll make 10x on the winners. So in this environment of change, in this environment where inflation is persistent, governments continue to spend on assets that are linked to strategic needs, energy, chips, metals, and defense. how do we position our portfolio? Not as a traditional credit fund, which is essentially just doing paper returns, but for a world where the economy is increasingly K-shaped. Policymakers are chasing unicorns. They continue to spend. They continue to chase primacy, to chase victory in certain strategic areas. And markets become increasingly correlated and increasingly prone to tail events, not just negative tails, but also positive tails. So diversification becomes a thing of the past. The negative correlation between risk-free assets, so government bonds and equities, becomes a thing of the past as well. And you have to think about a portfolio a lot more as a barbell, where we are doing relative value at each point in time. There are interesting opportunities in a very dispersed markets where different sectors, different ratings are going in different directions, as I was showing you earlier. But at the same time, you are going long real assets and you are shorting paper assets, which are very levered. Which are the good assets? Well, one of them is Ukraine. In this larger agreement between the US and China, if there is an agreement where China gets access peacefully to Taiwan, the US gets access to energy, there is a commercial exchange, then China might support Iran a little bit less, and China might support Russia also a little bit less. Russia has made little gains over the past 6 to 9 months on the ground. The war has changed. Ukraine has monetized its technology, its advanced use of drones, and has been able to get contracts of several billions in the Middle East, in Germany, and in Norway. Growth in Ukraine has been good, and companies are ready to invest. And in the event of a ceasefire, not just government bonds, but the broader array of Ukrainian assets will perform extremely well. This is a country which has 100% willingness to pay their debt, both at the country sovereign at the corporate level. And it is currently still one of the cheapest and under-owned assets in the Western world. Potentially a country that will become a member of the European Union and that is trading at double-digit yields. The second interesting opportunity that I want to talk about that's linked to this is Hungary. This has taken very little news space, but Hungary has kicked out Orban, which was one of the Russian assets in Europe. Now, without Orban, the European Union is a lot more united, and decisions are already happening faster and in an easier way. The new government in Hungary is already pro-European, and the credit spreads on the country have tightened. And together with this, we've seen a very strong appreciation in the currency as well. So we continue to see upside in Hungary, but the change in Hungary is also a symptom that populations in Europe, in countries where pro-Russia and populist governments were thriving, are changing their mind. Maybe not everywhere, but it is good news for Europe as a whole, and it is good news for Ukraine. Which other areas of value are interesting? Well, Venezuela is not a cheap bond. It's a defaulted bond. It's a restructuring. There's a restructuring going on, but it's still something that has upside and will be an investment destination together with Ukraine. So it's something that we also like. And generally what we like is assets that give us exposure to energy, to commodities, to hard assets, not just a coupon. So convertible debt in non-US markets, which remain extremely cheap, convertible debt in Chinese companies, convertible debt in European companies, for example. So not just credit on the long side, hard assets, equity, upside in assets that are linked to commodities, and assets that are bonds but convertible into equity and that we buy with a discount. What are the things we don't like? We don't like assets that are very levered, assets that will survive only if interest rates stay down, because central banks might not cut forever. And actually, they need to hike. They have needed to hike for a while. We don't like companies that are really levered, that are exposed to private credit, which have been lending with very limited lending standards and in a rush, let's say, over the last 5 years. We don't like companies in technology, companies that have dying business models, that have been making their corporate governance and their governance structure more complex. and companies that have been shifting their debt from public to private because they had something to hide. I'm not going to talk about the shorts in particular, but if you're one of our LPs, feel free to come back to us and we'll be very transparent about the companies that we don't like. But overall, we are short government debt and we are short tight credits in sectors that don't have hard assets, so sectors that provide only services. And we see downside in countries that are going to become increasingly levered, that don't have hard assets, that import hard assets and only export services. The UK is a case in point. With that, I think we are at the right time to start questions. And before that, I'd like to say we're probably going to see a bit more volatility this year. It's a volatile year, but the conviction that we have in our longs and shorts is pretty high. We think we're positioned for this new environment in the right way versus the typical old-style traditional world of credit where investors maximize carry or maximize a return that is linked to the coupon that the company is trying to pay. Here we have game-changing shifts in the world. Some companies might not survive. A lot of tech companies, a lot of software companies might not survive. So it's very important to be super selective, to focus on assets that have long-term survival, long-term support, to be concentrated in these assets, and sometimes to withstand a little bit of volatility. With that, open to questions.
Thanks, Alberto. So I'm going to summarize the questions that are coming through, try and group them. The first set of questions I would say are around rates. So we've seen, especially in Japan at the back end, we've seen rates widen. In the US, we're only pricing in one hike in 12 months. In Europe, we're pricing multiple hikes this year alone. How do you think about the rates markets? Do you think there's still room for us to widen given the fiscal spending and so forth?
So we think rates are on a widening path, and inflation is likely to stay above, not just above 2, but above 3 in the US. So why have rates not widened more is my question. And there's been a lot of control from the Fed, from the Treasury, issuing lower maturities, asking other central banks potentially not to hike. We know that there's some relationship between the Fed and the BOJ. But eventually, some central banks are hiking. The RBA is hiking, the BOJ needs to hike. And if they don't, the long end will widen. But simply put, government bonds don't compensate you enough for what's coming. And despite high deficits, Western governments have no choice than to spend more because you have a very K-shaped economy. So most of the population in the lower leg of the K is not very happy. So you cannot cut benefits. As Milton Friedman used to say, there's nothing more permanent than a temporary government program, right? It's very hard to do austerity. It's a word we never hear. But at the same time, you have new spending needs in defense and strategic resources, which are very hard to delay. Now, some countries have prepared for this. You could say Germany prepared for it for this moment for 20 years. But other countries are already very levered, and they've already used a lot of ammunition, and their curves will be more volatile. Think about the UK, think about France, for example. So we are generally short rates, and if rates widen, we're positioned to capture that volatility. We actually think that corporate balance sheets on average are better at this point than Western government balance sheets. In emerging markets, there's all sorts of different situations. There's countries that have very wide rates like Brazil, which we like. And so it changes from country to country. But in the West, typically you're not getting paid for duration risk, and the correlation between risk-free assets and risky assets is positive, not negative. But this also means that rates sometimes are a very inexpensive hedge in case of a prolonged inflation environment, a prolonged geopolitical stress environment.
And on the point about correlation, there's another set of questions coming through saying we've seen a little bit of a breakdown in the correlation between, let's just say, alternative currencies like gold and so forth, and rates in the last few months. Can we go back to a scenario where we've got rates widening and precious metals, gold, silver, etc., going back up, maybe to new highs?
Ultimately, the alternatives to paper are going to do well in our view because of this environment of high spending and governments continuing to spend, but at the same time, central banks remaining dovish. Now, there's a question, will at some point central banks change their mind not just the Reserve Bank of Australia, but not just the BOJ, but also the Fed. And maybe that point does not come in 2026. We are at very tight spreads. We are at increasing leverage in the US, and we are at 15 years of long positioning in US credit. Europe is a different story. Spreads are a little bit wider, fundamentals a little bit better, and inflation is at 2.2%. But there are some markets in credit where you had a lot of liquidity support. So when does that liquidity support disappear? Well, maybe it continues to stay here well into and after elections. So we might see a continued deterioration, gradual deterioration in credit markets, but not a spike. But eventually, the amount of debt, the amount of leverage that is in credit markets does not compensate you. Spreads that do not compensate you for the amount of leverage that we see. So we continue to be pretty short on the whole private credit stack, which is very inexpensive, and on the tightest, most leveraged structures that we see, particularly in the US market. And here the stress contagion channel goes through the insurance companies, not through the banks. For more on that, I would recommend you to look at our past webcast with some external guests that's on our website.
And then maybe as a final question, taking it back to the credit, which you said credit spreads are tight pretty much everywhere. We're near 20-year lows everywhere. Are there parts of the credit market where you feel like people are quite short, where the technicals are better versus, say, for example, private credit?
So I would say that the general positioning in credit is to be long, not from us, but from other investors, is been to be long assets that are low liquidity assets. So private credit or loans or CLOs or even relatively less liquid bonds, and to hedge with credit default swaps. So what this has created is an extra premium on credit default swaps, both in the actual instrument and in the indices, and also in the volatility in the options, because you have the large majority of investors holding assets trying to hedge these assets. But what happens in a month like March or April is actually that the protection, the credit default swap protection, yes, it tends to move, but then it doesn't really protect you because the CDS index and those assets tend to be higher quality. So we do the other side. We take the other side, and we are very nimble in our book. We don't have illiquids, we don't have loans, we don't have level 3. We're a liquid fund. And when these opportunities arise, we want to take the other side. So we essentially take the premium of liquid assets and trade that. And that's been a good source of returns, together with positioning for a rate widening, which we continue to think will happen. I think that's it for today. I hope that this quick upset gives you a flavor of how we're thinking about the world and how we're positioned. But of course, for more questions, please feel free to reach out to us and to the team. It's going to be a volatile market, but I think it's a very interesting market with a pretty interesting opportunity set. So good luck for the coming months, and see you soon at our next webcast.